Interest rates have become the defining force behind nearly every asset class in today's economy. Whether it's stocks, bonds, real estate, or even commodities, the direction of interest rates influences valuations, capital flows, and investment strategy. As we look ahead to the next 3 years, covering 2025 through 2027, projecting where rates are heading requires a deep dive into central bank behavior, inflation dynamics, labor markets, fiscal trends, and the broader macroeconomic environment. As of mid-2025, the United States Federal Reserve has kept the federal funds rate in a range between 5% and 5.25%. This follows a prolonged period of aggressive rate hikes that peaked in 2023. While inflation has cooled, the Fed has remained cautious. Recently, their tone has shifted from hawkish to more dovish, with the possibility of rate cuts beginning in the latter half of 2025. However, Fed officials have made it clear that any policy easing will be entirely data-dependent. They are closely watching inflation and employment data before making further moves. Based on current futures pricing and economist forecasts, the market is expecting 1 or 2 modest cuts by the end of 2025, bringing rates down to somewhere around 4.5 to 4.75%. Moving into 2026, a more noticeable shift is likely. If inflation continues to trend downward and economic growth remains stable, the Fed could cut rates more substantially, potentially reaching a range between 3.5 and 4%. By 2027, barring any major economic shocks, interest rates are expected to normalize and stabilize between 3 and 3.5%. Other central banks, such as the European Central Bank and the Bank of Canada, are generally expected to follow a similar trajectory, with some easing starting even earlier due to softer economic conditions in their respective regions. Inflation plays a central role in this outlook. After spiking in 2022 and 2023, inflation has been declining, though not in a straight line. As of now, core personal consumption expenditures, commonly known as core PCE and the Federal Reserve's preferred inflation measure, is running at around 2.8%. Elements like shelter costs, service sector wages, and healthcare remain sticky, preventing inflation from falling more quickly. Still, the consensus view among economists suggests inflation will fall to around 2.5 to 2.7% by the end of 2025. By 2026, it's expected to move closer to the Fed's 2% target. In 2027, inflation is likely to remain anchored, although global risks such as geopolitical conflicts or energy supply disruptions could create short-term spikes. The labor market continues to show resilience, which is both a strength and a challenge for the Fed. Unemployment remains low at around 4%, and while job growth is cooling, wage growth has been steady. This balance means that the Fed does not feel rushed to cut aggressively, but is also wary of over-tightening. Real GDP growth for the US is projected at about 1.7% in 2025. This slightly muted pace reflects the impact of high interest rates and tighter credit conditions. By 2026 and 2027, growth is expected to pick up slightly to around 2%, supported by easing monetary policy and structural improvements like increased productivity from artificial intelligence and automation. Fiscal policy also plays an increasingly important role in shaping the interest rate environment. The US continues to operate with large fiscal deficits, which means the Treasury must issue a growing amount of debt. This heavy issuance puts upward pressure on long-term bond yields, especially if investors begin demanding a higher risk premium. As a result, even if the Federal Reserve lowers short-term rates, longer-term interest rates might stay elevated due to these fiscal pressures. Global macroeconomic conditions are also important to consider. A sluggish recovery in China, stagnation in Europe, and ongoing geopolitical instability, from the Russia-Ukraine war to conflicts in the Middle East, could all impact commodity prices, investor sentiment, and the global demand for US Treasuries. From a technical standpoint, the yield on the 10-year US Treasury has been trading between 4.1% and 4.5%. A breakout below 4% could signal that investors have strong confidence in falling inflation and a dovish Fed pivot. Conversely, a move above 5% might indicate renewed inflation fears or concern about rising US government debt. Currently, the yield curve is inverted, with short-term rates higher than long-term ones. This is often seen as a recession signal. However, in the coming years, the curve is expected to steepen as short-term rates decline, and long-term rates hold steady. This re-steepening is typically associated with the beginning of a new economic cycle and has historically been bullish for stocks and risk assets. For investors, these interest rate projections carry significant portfolio implications. In fixed income, the environment is becoming increasingly attractive. With the Fed poised to cut, longer duration bonds such as 10-year treasuries or municipal bonds could benefit from capital gains as yields fall. Investment-grade corporate bonds also offer good value, particularly as credit spreads remain tight and defaults are low. In equities, sectors that are sensitive to interest rates, like technology, real estate, and utilities, stand to benefit the most. These areas were hurt during the rate hiking cycle and could now see renewed investor interest. Dividend-paying stocks may also regain favour as bond yields decline, making equity income more appealing by comparison. In the world of real assets, real estate and infrastructure could finally stage a comeback. After struggling with high borrowing costs, falling interest rates may provide a much-needed boost to property valuations and development. Commodities, especially energy and industrial metals, remain a wild card. They continue to serve as hedges against inflation shocks and are also influenced by global supply constraints and geopolitical dynamics. Cash and money market instruments, which have been popular in the high-rate environment of 2023 and 2024, may become less attractive as rates fall. While short-term yields are still appealing today, their relative advantage will erode, prompting investors to seek higher returns through bonds, equities, and alternative assets like private credit or REITs. However, there are risks that could disrupt this trajectory. Inflation could re-accelerate due to energy shocks, wage spikes, or supply chain disruptions, forcing the Fed to pause or reverse its rate cuts. A fiscal crisis could also emerge if investors lose confidence in the US government's ability to manage its debt, leading to higher long-term yields even as the Fed loosens policy. Geopolitical instability, financial market stress, or a hard landing recession could all push rates lower faster than expected, but at the cost of significant volatility across asset classes. In conclusion, the next 3 years are likely to see a gradual and cautious path of rate reductions, not a return to the ultra-low interest rates of the last decade. Investors should prepare for an era of structurally higher yet more stable interest rates. Portfolios that are diversified and tilted toward quality bonds, rate-sensitive equities, and real assets will be best positioned to navigate the coming cycle. While the road ahead may not be smooth, it presents compelling opportunities for thoughtful, forward-looking investors. If you found this analysis helpful, make sure to like the video and subscribe to the channel for more deep dives into market trends, stock analysis, and investment strategies.